So we know that the US side of the story is one where rates are going to remain elevated. Now, on the dollar-yen side, and the impact that has from the US perspective, is that dollar-yen across the G10 currencies is, of course, the most sensitive of the G10 currencies to relative rates. So to your original point, and we fully back this up in terms of the US perspective, if this implies that the rate differential between the US and Japan further widens, then clearly the risks are biased very much towards the upside on dollar-yen. I would add a couple of points to this, though. The first one is it possible that we may actually see the Bank of Japan actually move over the next few months in terms of rates? Now, that will, of course, offset some of the widening rate differential. Our view is that we could easily see the Bank of Japan moving in June. And so that would be a buffer to some of the rate differentials. The other point, of course, is that if you continue to see spread widening, then the fact that certain investors, like real money investors, are now neutral on the yen implies that, again, they could actually undertake further short positioning as well. So the spread differential matters, but the positioning matters a lot as well in terms of how this plays out from here.
Completely agree with you. But Dwyfor, if the BOJ moves on rates, right, and that would somewhat squeeze the rate differential with the US, how does that thought process, how does that thesis of yours set in with the expectation that's growing about how the Fed may not be done with rate cuts, how they could possibly be looking at a rate hike? And so wouldn't that spread still be intact?
Well, that's an entirely different outlook then, because truth is the Fed have realistically not intimated rate hikes. I mean, that story has made its way through the markets in recent weeks. But if we look at the dots, for what they're worth, I mean, they are the market guide. They are the forward guidance from the Fed. If we look at the dots are arguing that 2024, but particularly 2025, will be a period of rate easing. If you're now arguing that the Fed is now moving towards rate hikes, then that's a completely different sort of environment as far as the Fed is concerned. That then opens up a significant amount of not only dollar versus yen implications, but implications elsewhere as well, because, of course, we think that the ECB is going to move the middle of this year. We think that the Bank of England is going to move the middle of this year. And if this implies continued dollar strength, then that has far broader implications than just dollar-yen. But, of course, if you're now saying that the Fed is going to move towards rate hikes, which we don't necessarily agree with, but if they do, then clearly the rate differentials are going to play in the dollar's favor far more significantly.
Okay, let's game out the most likely set of circumstances, because, you know, we have the QRA as well, and if they keep this tilt towards bills and don't go coupons, eventually it's going to come to task that there's going to have to be this incredible supply coming through of coupons. Eventually, it has to happen. There's no two ways about it. In terms of the supply-demand dynamics to that effect, if we see, you know, the JGB starting to not get as bought as often as the BOJ has been doing and as voraciously as they have been doing, and we see that rates crawl higher in Japan, what's that going to mean for that yield differential as well? Because I'm thinking, no matter what the circumstances are, for the most part, it's almost as though the BOJ is stuck in the way that it positions, and we're not even talking about the financial stability risk of rates running higher in Japan either.
And you notice that the Bank of Japan has, to the point that it's somewhat boxed into a corner here, you notice the Bank of Japan has really said very little about its JGB purchases and how it intends to actually, how it intends to deal with its JGB purchases, which comes back to the point that if it needs to tighten policy, the easiest way for it to tighten policy is explicitly through rates, because it's not so obvious what it can do on JGB policies right now, given how much of the market it actually owns. So